Welcome back to the channel, everyone. Today we're dissecting what I call the NIO paradox. On one hand, you have a stock chart that looks like a total disaster. The stock is down 5% in just the last week, down 6% year to date, and investors are sprinting for the exits. But on the other hand, when you look at the actual business underneath, NIO's fundamentals are strengthening at an incredible pace. We're seeing accelerating top-line growth, consecutive quarters of margin expansion, and a widening technological moat. The market is pricing NIO as if bankruptcy is right around the corner, and yet the data tells us the company has never been operationally stronger. How can both of these things be true at the exact same time? And that brings us to the multi-billion-dollar question. Does this approaching catalyst represent a terrifying trap or the single greatest buying opportunity of the entire year? Mark your calendars for Tuesday, September 1st, before the U.S. market opens. That is the precise moment NIO will drop its unaudited second quarter financial results. Every major fund manager, every retail short seller, and every electric vehicle analyst is going to be watching this report like a hawk. The stock has been beaten down so hard that even a merely decent report could trigger a violent snap higher. But we don't guess on this channel. We follow the hard numbers, and to understand what might happen on September 1st, we first have to trace the path of how NIO proved to the entire world that its business model can actually work. If we rewind just a few months to a historic milestone, we can see the blueprint of NIO's future profitability laid out in plain sight. In March of this year, NIO did something the critics swore was flat out impossible. They posted their first ever quarterly GAAP net profit of $40,400,000. And they did it on the back of an astronomical 83.6% year-over-year revenue surge, climbing to nearly $5 billion, while delivering a record-shattering 124,000 vehicles. This was a massive watershed moment. It proved once and for all that under peak delivery volume, NIO's unique business model isn't some cash-burning science experiment. It is genuinely, powerfully profitable. But of course, the market immediately fired back with a challenge. What happens when vehicle volume naturally cools off during the slower first quarter? Well, the first quarter rolled in, and NIO absolutely obliterated management's own expectations. Revenues skyrocketed 112% year-over-year to 25,500,000,000 renminbi, or roughly $3,700,000,000. Deliveries came in at over 83,000 units, nearly 100% growth year-over-year, completely blowing past the company's own guidance ceiling. Just let that sink in. The top line is growing like a high-flying technology company, not a slow, lumbering legacy automaker. So if the revenue is exploding like this, why on earth is the stock still getting crushed? The answer lies in a hidden nuance buried in the profitability numbers, and it's something the vast majority of investors completely missed. If you only read the headlines, you'd see that NIO reported a GAAP net loss of 332 million renminbi, and the bears pounced instantly, screaming, "See? They're still bleeding money." But look closer, because this is where it gets interesting. The GAAP loss was a staggering 95% reduction from the devastating 6,750,000,000 renminbi loss they posted in the same quarter a year earlier. And here's the part almost nobody talks about. On an adjusted non-GAAP basis, NIO actually reported its second consecutive quarter of operational profitability, posting an adjusted operating profit of 66,800,000 renminbi, or nearly $10 million. What does that mean in plain English? It means their core automotive business is now officially self-sustaining. So how exactly did they pull off this incredible turnaround? To answer that, we have to zoom in on the single most important metric for any manufacturing company on the planet, the margins. This trend is honestly a thing of beauty. 4 consecutive quarters of sequential margin expansion. NIO's gross margin has climbed from a paltry 7.6% all the way up to 19%. That is a 4-year high, and it gets better. Their vehicle margin hit 18.8%. Let me translate that for you. NIO's operational efficiency is scaling faster than their raw delivery volume. They are squeezing more profit out of every single car they sell. This proves their premium pricing power is holding rock solid, even while the rest of the industry is drowning in a brutal price war. But here's the thing that keeps skeptics up at night. None of these widening margins mean a thing if the company runs out of cash before the turnaround is complete. So can NIO actually survive the war? To win a price war, you need a war chest, and NIO has built an absolute fortress of a balance sheet. As of March 31st, the company was sitting on 48,200,000,000 renminbi, or approximately $7 billion in cash and highly liquid resources. That is a colossal safety net. It means NIO can comfortably absorb any short-term cash burn, keep pouring money into research and development, and aggressively fund its massive brand expansion, all without staring down the barrel of bankruptcy or desperate shareholder-crushing dilution. So the survival question, answered. Now let's look at the scorecard. How does everything stack up when we compare where NIO has been to where it's heading next? Let's lay every card on the table. When we study this earnings scorecard, the trajectory becomes crystal clear. The fourth quarter of last year was the peak profitable volume quarter. The first quarter was the seasonal slowdown that still managed to crush expectations. But now, we have the official numbers for second quarter deliveries, and here is the catch. NIO delivered 107,658 vehicles. Now, if you look at the second quarter guidance, management had targeted 110,000 to 115,000 units, which means they missed the floor of their own guidance by 2.1%. Well, now, on the surface, a delivery miss is exactly why the stock has been sliding all week. But if we dig deeper into the real numbers, this so-called miss is wildly misunderstood. Yes, NIO missed the floor of their second quarter guidance, but context is everything here. First, that delivery figure still represents a massive 49.4% growth year over year. Read that again, nearly 50% growth, and the market is treating it like a catastrophe. Second, the entire miss traces back to a minor bottleneck in June, when deliveries of 40,500 units fell just slightly short of the required monthly run rate. This wasn't a demand problem. Nobody stopped wanting the cars. It was a temporary, fixable volume hiccup. And yet the market reacted with pure, unfiltered panic, hammering the stock down to $4.58, completely ignoring the fact that NIO's overall growth trajectory remains breathtakingly healthy. In fact, despite this delivery miss, Wall Street is quietly bracing for a massive financial turnaround when those numbers drop on September 1st. So what exactly are the analysts expecting? Wall Street is forecasting a consensus loss of just 7 cents per share for the second quarter. That is a massive 78% year-over-year improvement compared to the 32-cent loss they posted a year ago. And it gets even more exciting. Deutsche Bank predicts that NIO's premium SUVs will drag the company all the way back to a non-GAAP net profit of 180 million renminbi, representing explosive 304% sequential growth. And this is precisely why we're witnessing a titanic battle over institutional ownership right now. Institutional holding stands at 48.5%, and in the second quarter, the big players added a net 2.4 million shares. Morgan Stanley led the entire charge, aggressively buying 12,700,000 shares to become NIO's largest institutional holder. UBS piled in with 7 million shares, and Bank of America scooped up 4,800,000 shares. Now, yes, some funds like BlackRock and JP Morgan trimmed their positions, but BlackRock was simply rotating into US EV names, while D.E. Shaw actually held on to $123 million in senior convertible notes. The takeaway is unmistakable. The smart money is not abandoning NIO. They are positioning for a massive fundamental re-rating. So what could possibly make these Wall Street giants place bets this enormous? When you see what's actually driving this turnaround, you'll finally understand why the biggest names in finance are loading up. The real engine behind NIO's margin explosion is its highly profitable premium product mix. NIO's average selling price rocketed to over $65,000 in July. Why? Because their premium SUVs are absolutely dominating the road. Their mature ES8 SUV is closing in on its 140,000th delivery this week, and the flagship ES9 SUV, which launched in late May starting at nearly 500,000 renminbi, shattered the premium EV record in China by delivering 20,000 units in just 73 days. And the non-cancelable order backlog for the ES9 is estimated at over 40,000 units, with wait times stretching all the way up to 14 weeks. But honestly, that's only half the story. NIO is also quietly building enormous technology and infrastructure moats that the market is almost completely ignoring. Shipments of their proprietary NVIDIA-rivaling Shenji NX9031 autonomous driving chip have already topped 300,000 units. Morgan Stanley notes that this single chip unit moves NIO, in their words, one step away from being just a cash-burning EV maker and serves as an incredibly valuable call option as NIO expands into external AI chip sales and even robotics. They also invested $23 million into memory chip giant CXMT's IPO, which surged a jaw-dropping 466% on its debut, locking in massive paper profits and securing cheap supply chain costs. And on top of all that, their capital-heavy battery swap network is transitioning to state funding, with Cherry taking a 10% stake in NIO Power, transforming what was once a heavy cash drain into a high-margin recurring revenue machine. Could this really be the same company everyone left for dead? To capture the entire market, NIO isn't just clinging to luxury SUVs. They're launching a full-scale, multi-brand offensive. NIO is executing a brilliant three-brand strategy designed to capture every single pocket of the market. Under the core luxury NIO brand, they've got the high-margin ES8 and ES9. Under the mass-market OneCk brand, they are going straight for Tesla's throat, aiming directly at the Model Y. In fact, just tonight, OneCk officially launched its refreshed L60 midsize SUV at a starting price of 192,800 renminbi, or a mind-bending 135,800 renminbi under the battery-as-a-service model. That is 6.8% cheaper than the previous version and dramatically below Tesla's Model Y price of 263,000. OneCk also launched the L80 SUV back in May, and collectively, this brand delivered over 29,000 vehicles in the second quarter. And finally, their compact premium brand Firefly delivered over 17,000 units in the second quarter and is now making its right-hand drive debut in Hong Kong, targeting expansion into nearly 40 countries around the globe. So when you combine this multi-brand explosion with the technical setup, could the chart be flashing the loudest buy signal in years? When you overlay this business momentum onto the actual price chart, the setup becomes downright explosive. Looking at the technical chart, the daily price action is carving out a massive textbook cup and handle pattern. The bottom of the cup sits perfectly at the $4.37 multi-year low, and the upper rim rests at $7. Right now, we are sitting squarely in the accumulation zone of the handle, trading at $4.58. If we break above the 50-day moving average at $4.86 and reclaim that $7 rim, the technical breakout targets an implied move all the way to $9.63. That's a 110% upside. And here is the fuel that could light this entire thing on fire. The short interest is enormous. There are currently 122,800,000 shares held short, which is a massive 5% of the public float. With a high days to cover reading of 5.5 days, any positive earnings surprise on September 1st could force these shorts to panic buy, igniting a genuinely violent short squeeze. Meanwhile, the smart options traders are leaning heavily bullish, with the overall put-call ratio sitting at a rock-bottom 0.4, an enormous open interest stacked up and out-of-the-money calls at the $9 and $10 strikes. The risk-reward here is tilted dramatically to the buy side. So after reviewing all of the hard data, what is the exact trading setup, and what is our final verdict on NIO stock? Here's our final verdict. At $4.58, NIO is trading at an absurdly cheap valuation of just 0.6 times price to sales, which is a massive 25% discount to its peers. The extreme market pessimism is already fully baked into the price, which means your downside is heavily protected by that absolute historical floor of $4.37. And at the same time, the fundamentals have literally never been stronger. Now, before we get to the exact setups, I have to be crystal clear about something important. I am not a financial advisor, and absolutely nothing in this video is financial advice. Everything you've heard today is for educational and informational purposes only. Investing in stocks, especially volatile EV names like NIO, carries real risk, and you could lose money. Always do your own research and consult with a qualified financial professional before making any investment decisions. Okay, with that out of the way, let's talk setups. For the aggressive trader, there's the short-term tactical play. You'd look to enter buy orders in the current accumulation zone between $4.49 and $4.58, or on a confirmed close above the 20-day moving average of $4.70, with a strict stop loss at $4.30, just below the 52-week low. The first profit target sits at $5, with a second target at the resistance zone of $5.35, giving an asymmetric 1 to 2.75 risk-reward ratio. For the long-term investor, there's the strategic play, dollar-cost averaging into shares between $4.40 and $4.80, doubling the position on a breakout above the cup and handle lip of $7, with a long-term stop below macro support at $2.95. The 12-month target lands at Wall Street's consensus of $6.70 to $7, with a macro target of $9.63, delivering a 1 to 3.1 risk-reward ratio. The fundamentals are aligned, the smart money is in, and the countdown to September 1st has officially begun. So now I want to hear from you. If NIO delivers even a slightly better than expected report on September 1st, do you think this stock could double before the end of the year? Or is Wall Street about to get caught completely off guard? Drop your honest prediction in the comments below. I read every single one. And if this breakdown brought you value, smash that like button and subscribe so you never miss the next big setup. I'll see you in the next video.